Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
Good morning. Welcome to the Finance Friday edition of Wealth Coffee Chat. I'm joined today by one of our senior brokers, Sarah. You may have seen her before on Wealth Coffee Chats that I haven't been able to host. So, what's a broker's favorite board game? Monopoly, of course.
Oh, God.
We're not actually coming for you. We're not actually coming live today. Both Sarah and I are actually at a conference, so we're actually away on Friday morning. So it's pre-recorded. So sorry, can't engage with you in the chat, but we hope that this session will give you some insights. As always, I love to start with the interest rates. The sad news is interest rates are unlikely going to be moving down any more time this year. With monthly inflation for the month of August increasing to 3%. The RBA likes to keep it between 2 and 3, so we're at the high end of that, and most likely the RBA are going to want to start seeing it fall before they look at cutting rates again. Now, it's increased from 2.8% in July, not heading in the right direction for the RBA. In saying that, Westpac are saying that they are expecting rates to come down in November, and they're also expecting another 3 rate cuts in this particular cycle. CBA and ANZ expect the next rate cut to come in February next year, and they only expect 1 left in this cycle, and NAB are saying that rates could be on hold until May of next year, with them also expecting that there's only 1 more rate cut in this particular cycle. So that's our interest rate update for this week. We're gonna have a chat today about borrowing power, borrowing capacity.
Yes. So I guess what I wanted to cover with you guys today was around borrowing capacity and what we can do to influence that. Traditionally, what we see with borrowing capacity, anything over the 80% mark, and I'm talking in individual names here, 80% LVR and above, so that percentage of the property value that we're borrowing against, is mortgage insurance territory. So LMI, you would hear that term quite often, needs a bigger buffer for the surplus that needs to remain over at the end of each month. So, for example, what we find when we're looking at lenders' serviceability, technically, although the lenders don't like it, it technically needs to have $1 surplus. So, as I said, lenders aren't going to love that, but when we're going into mortgage insurance territory, though, we tend to be seeing more around the $2 to $3 up to $500 per month surplus. So what you can see is that that surplus will then flow onto your borrowing capacity side, because that lowers the loan that you'll be able to actually take out. Other things that can influence that as well is principal and interest versus interest only. The reason for that, principal and interest repayments would have a higher borrowing capacity, or would allow you to have a higher borrowing capacity as opposed to interest only, because now when the lenders are looking at it from an assessing point of view, they're looking at it just purely for the amortization period. So amortization is the amount that we're reducing that loan to zero over a period of time. So traditionally, we can go up to 5 years interest only with majority of lenders. There are some that will make an exception to that. So then the amortization period would only be over a 25-year period. So you can see again how that would lower your borrowing capacity in terms of overall surplus, because now we need to have a bigger buffer, and also that the amortization period is lower. There are exceptions to that.
Just a question. When you're talking about the buffer, you're talking about what the banks look at in terms of how comfortable they actually are to lend you the money, right?
Absolutely. So when we're talking about surplus, there is, we do a calculation that we call serviceability, but for the ones that have been around for way too long, we used to call it the stress test. So all we're doing is we're stress testing your financial situation, and that would result in an X amount left over per month. Okay, so if we take out a loan and let's say there's $150 left over at the end of the month, that doesn't actually mean that you're going to have $150 left over at the end of the month. It means that in a pressurized environment where there's buffers being placed on top of the interest rates. Yeah. So what we tend to find with prime lenders, like your top 4 banks, your ANZ, CBAs, etc., they tend to be around 3%. Non-conforming lenders, famous ones being Liberty, Pepper, etc., they tend to be more around the 1 to 2% because they're more generous in their borrowing capacity. So what we find then is that leaves a certain amount left over at the end of each month, and that is what they're focusing on to show the strength of the deal. There are exceptions around the LMI premiums as well. So mortgage insurance is a really good way of reducing the deposit needed to get into the property. So once we cross that 80% mark, now we're in mortgage insurance territory. Okay, so that is a one-off premium that goes on top of the loan that insures the bank in the event of default.
No benefit to the...
No benefit to you whatsoever. You are not contacted. It's actually kind of a negative
for you.
No
insurance for you. It's purely the banks covering themselves.
It's 100% for the bank and in their favour. And if you do default, then the mortgage insurance company actually comes after you. So
personally, yes.
For the honour of having that, you're going to pay a one-off premium, and that's going to be placed on top of your loan. There are waivers, though, for certain industry professionals. So a really common one is medical professionals, and I think a lot of people would know that one. But the breakdown around that, so it's not just the surgeons and the doctors and things like that. It can be registered nurses, it can be paramedics, it can be all sorts of roles within that. Different lenders will have different parts of that medical professional. But there's also essential services, so police, fire, ambulance, teachers, all those sorts of things. They are lenders that have niches around that to waive the mortgage insurance for those industries. And the reason for that is obviously their analytic side of showing the I guess, more safer roles in that. So that's why they're willing to lend up to
They're also
9%.
their roles are very high demanding as well.
Yeah, that's right. So easy to get jobs, you can move from one job to another quite simply, and you're always in demand for that.
And they're the ones that you'd get, their overtime and all the allowances.
Yeah, so we get
at
100%. Yeah, so just for people that aren't aware of that, if we're looking at, let's say, overtime as an example, what we tend to see is that lenders will only take a percentage of that. It's a high percentage, so probably around the 80% mark, but there is still a 20% buffer in there. But if you are essential service, then they will use 100% of the income purely for those reasons.
Now, we've had a few lenders who've actually released a list of LMI waivers.
Yeah.
And I noticed that there are a few industries that I haven't seen before on there. I think it was IT professionals are now in there.
Yeah, they're starting to really move around a fair bit. I think lenders are going to start focusing on these LMI waivers to try and attract these kind of professionals into their lending. We'll probably see that more in the prime space first, I think, and then that'll move through to the smaller lenders.
It feels like the goal there is for those who earn a high income to be able to get into property a lot faster. And here's a way, again, LMI is an insurance for the lender. So they could choose to waive whoever they would like to because they feel safe with those clients in that particular industry. The other ones that are popular as well is accountants and lawyers. They also get LMI waivers. Now, the thing to remember about this is actually for individual borrowing.
Yes.
Now, a lot of these clients may want to borrow under entities like companies and trusts. The LMI waivers won't necessarily be able to apply. Again, it is specific to the lenders, so it's worth having a conversation with your brokers about it to find out which lenders will actually, because there's some scenarios where doctors can purchase under trust, but they qualify for the mortgage insurance waiver because of the occupation.
Yeah, and I think we're always going to get lender niches around that. So as Cang was saying, that there are certain lenders that will do things outside the square, but it does come down to the lender's discretion and their policies around that too. But for the rest of us that don't get LMI waivers, like mortgage brokers, we have to pay. We don't know why. We don't know why. I feel that would be a very good industry to get an LMI waiver. But there is some niches around that as well that we can use as part of your financial strategy. So for an example, there are lenders that will go up to 95% for investment. So what that means for you, traditionally, what we tend to see is that we can allow, let's say the lender cuts us off at 90%. It means we can actually only borrow 88% and leave 2% buffer for the premium. But if we can go to 95, it means that we can actually add the LMI premium on top of that. So you're actually really borrowing 97% of the property value overall.
It'd be closer than 98, wouldn't it?
Yeah. They usually cut it off around about the 97. So let's say 94 to 95 to give yourself a little bit of movement, because premiums at that level are going to be high. But there are lender niches that will let us go up to that. And there are niches around that. So a niche on a niche, we can do principal and interest repayments, but we can also look at interest-only repayments with a couple of lenders at that level as well, which I think is really good, particularly for investors. We're trying to minimize deposit.
It's a great product, and I've spoken about this previously, but the goal is to get into the property as soon as possible. And we talk about this a lot. This is a tool or a product that will get you into the property market. Yes, there are going to be some costs around it, but if you were to say, okay, if I don't get in now and I'll wait another year or two, the property price may increase to the point where you actually have to keep saving. You know, if your goal is to get to a 10% deposit, and it may take you 2 or 3 years, that
time out of
goal,
market.
but that goal keeps moving.
Mm.
And if you don't get in now, experience, a higher interest rate, but make sure that you have a conversation with your broker to go, how do we go from this product to your prime product?
Mm.
There's always going to be a roadmap. And so we have to make sure that you understand that this is not we're going to, brokers are going to get you in and you sit in this product for the next 30 years. It isn't.
No.
It is a tool to get in now so that once you're in, you can then work out, is it a year, is it 2, is it 3 years for you to take this journey to get to the prime lender. The great thing about this is that during that time, if you buy in the correct spots, the value of the property will actually increase.
Yeah.
Which means that you will get to 80% a lot faster than you could ever would be able to do if you were saving. So definitely, keep that in mind, because our goal is to help you get into the property sooner, but also be able to help you get into the premium products throughout your lending journey. So make sure that you have those conversations with your brokers around that.
Definitely.
Any last words?
No, I think that's about it, really.
Awesome. Well, thanks for joining us virtually.
Have a great Friday, guys.
Enjoy your Friday. Have a wonderful weekend, and we'll catch up with you all next week.
See you later.
Bye, guys.
Episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.